So we were sort of managing expectations going into this earnings season. How worrisome is the outlook and forecasting for you?
Yeah, thank you very much for having me back. It's great to be here. So I think if you recall back to the third quarter earnings, there were some very big misses, and particularly among companies like Amazon and Google. Some of these stocks missed earnings quite significantly, and then they fell 25%. So expectations were a bit muted going into this earnings season, and people were sort of, crossing their fingers and hoping that it wasn't going to be as bad as the third quarter. And actually, you haven't seen these sort of massive misses where you have mega cap companies that are going down 25% after. But as you mentioned in the introduction, the overall outcome from earnings so far has been quite disappointing in terms of there's not a lot of stocks that have very high growth, and a lot of the commentary and the calls are that there's not a lot of visibility for 2023. So our strategy right now is to stay in companies that are in an earnings upgrade cycle, because generally, a long cycle doesn't change one quarter or the other, and to stay in very high quality companies with high quality management, because they'll be able to manage through these difficult times better than low quality companies with questionable management.
And of course, when it comes to downgrade cycles, you're looking at tech and thinking that's still not appealing at this point, despite a lot of the, encouraging measures that we have seen from big tech in terms of the cost side?
So I think, you need to differentiate between big tech, so sort of like the former FANG mans, and then the rest of tech. In the FANG mans, and a lot of those companies have now changed their names, so we can't call them that. But you did see a lot of deceleration continuing in cloud. So whether it was AWS or Azure and Microsoft, those are big drivers of those businesses, and they were still decelerating quite significantly. So we are not invested in those companies. Apple still has a lot of headwinds in terms of the consumer side, and the supply chain is still not 100% normalized, so we have only a very small position in Apple. One company where there was some bright spots was in Meta, and that is a stock that a lot of people completely wrote off. We actually don't own it, but their results were very, very specific in terms of cost cutting, and that's why the stock went up so much, because all the analysts can easily go back to their desk, stick in the cost cutting numbers, stick in the headcount reduction numbers, and you can get quite good earnings upgrades. And the tone out of Mark Zuckerberg was quite different than what we've heard for years, actually, in terms of changing the strategy and focusing on cost and focusing on profitability. And I think that was a big surprise for everybody from Meta.
Are you looking for exposure to AI?
Yes, so AI is actually a very important thematic. So we are looking at exposure to AI, and Microsoft, what I mentioned before, and obviously ChatGPT is the sort of phrase of the day. But it's there is exuberance, and I actually just got back from San Francisco last week, and some of the feedback I heard is that ChatGPT is probably overhyped for what it is, but it's underhyped for what it could be and what generative AI could be in the longer term. So we are doing a lot of work on AI, and we're also doing a lot of work. We do have a sustainable fund, and we have very strong ESG criteria for all of our investments. We're doing a lot of work on what that means in the context of AI, because it's a very unexplored space, and it's something where people are going to have to come to conclusions pretty quickly, because it's moving very quickly.